Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies in 130 industries our analysts cover worldwide. Today, we'll look at why Palantir Technologies reported its biggest ever quarterly sales growth since the company went public.
Plus, we'll look at how the fast food chain McDonald's returned to sales growth last quarter.
But first, we begin with earnings from the media and entertainment giant, Walt Disney.
This week, Disney shares fell after the company gave a mixed earnings report in the third quarter. The results, well, they showed strength in Disney's streaming and parks business, but the company gave a lukewarm outlook for profit this year.
For more, guest host Isabel Lee and I were joined by Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media. We first asked Geetha, what exactly concerns investors about Disney?
Expectations might have been, slightly high. And the fact that they didn't necessarily give us any specific guidance for fiscal 2026, they did point to a raised guidance for EPS growth for fiscal 2025, 18% now instead of 16%, but they didn't necessarily give us anything specific for fiscal 2026. That could be a slight source of disappointment. They did say that they will stop disclosing Disney Plus subscriber numbers. But again, this is not something totally unexpected. I mean, Netflix has stopped doing this. We're seeing this kind of move away from just subscriber numbers to a greater focus on profitability.
I want to zero in on parks because I'm still scarred by how expensive it was when I visited a couple of years ago as an adult. But how sustainable is their strong parks performance given the divergent domestic and international performance?
Very sustainable, Isabel. So, we saw domestic parks, and I say that because, domestic parks actually coming into this year, coming into this quarter, there were a lot of worries. One, of course, about the general macroeconomic environment, but the bigger source of worry was really the opening of Epic Universe, which is, Universal's big Florida theme park attraction. But the fact that it had absolutely no impact at all, or very, very modest impact, if at all, is really amazing. And it just kind of speaks to the resilience in Disney's business model. They reported, again, very, very strong per capita growth, in terms of food and beverages, in terms of concessions. So all of that doing really well. And the reason I'm so positive about this business going forward, first of all, it contributes about 55 to 60% of Disney's profits. So really, really important to their top line, to their bottom line, definitely. They have a lot of upcoming capacity. So the biggest source of expansion over the next few months is really going to be their cruise ships. They're launching 2 new cruise ships, their biggest ever, actually, which is going to come on board in November and December. One of them sets sail from Asia, and that basically takes the number of cruise ships to 8 cruise ships, effectively kind of doubling their capacity in a span of just maybe 2 to 3 years. So that is going to really buoy, both top line and bottom line going into 2026. And then beyond that, you really have this huge $60 billion capital expansion plan that is really going to play out over the next 5 to 10 years. So we're going to see a lot more attractions all over the world. We're going to see that new Abu Dhabi park come out. So there is really a lot of, sustained momentum that we can expect at the parks going forward.
Geetha, talk to us about that deal they just made with the NFL. It seems like a really positive development for the company.
Yeah, it's really good, I think, from a Disney, from an ESPN standpoint, that they're so closely aligned now with the NFL. I mean, the NFL is absolutely the premium property, the gold standard, Paul. You know this well when it comes to, sports properties in the US. And the fact now that they're going to be able to use all of this content for their upcoming ESPN streaming launch, I mean, that itself just kind of gives it a tremendous boost, I think, even before it comes on board. So it's great for the product. It's also great from a strategic standpoint because the NFL is obviously one of the most important sports properties, and this really gives them access, or it at least definitely gives them a little bit of an advantageous position compared to, let's say, an Amazon or a Netflix or an Apple if they want to ever outbid, the current media partners. So definitely, I think a strategically very, very sound move on the part of Disney.
So it seems like we had a good quarter. Runway for growth is really just long and wide. What downside risks remain then, especially around the macro uncertainty and tariff exposure, do you see?
Yeah, maybe a little bit of execution risk. So we still really don't know how this whole, obviously everybody's very excited for the ESPN product launch, but we still don't know how exactly that's going to play out. Again, a huge source of upside is going to be the streaming business. Everybody's expecting huge cost savings when it comes to the integration of Hulu and Disney Plus. But again, execution is a little bit of a risk. And then you pointed out, macro factors. Remember, Disney still obviously has huge exposure because of its parks business. And anytime we see kind of a slowdown in the economy, we do feel that in the parks as well. And of course, advertising also. So, they do have a substantial exposure to advertising because of their TV networks business. So there again, we can see a little bit of an impact. But overall, as it stands right now, the business seems to be in really good shape.
All right, here the problem childs, though, are the broadcast networks and the cable networks. Just because of cord cutting, they're just declining businesses. What's the company saying about what they're going to do with those businesses?
They haven't said anything explicitly, Paul. So a few years ago, this idea was floated that maybe they kind of spin off ABC, their broadcast network. Maybe they spin off their linear cable channels. All of that, noise has kind of quietened down. Bob Iger basically said, no, we need these businesses. They're all kind of integral to the whole Disney story. So we haven't heard anything recently. That being said, just this whole deal with the NFL kind of taking an equity stake, it almost seems like they are prepping for ESPN and maybe ABC to kind of go solo. Remember, Bob Iger only has a few more months left. So at the end of 2026, he leaves Disney, or at least that's what he says. Yeah, we think. And I really think he kind of wants to get this deal done. So to separate ESPN, because it's not really core to the rest of the Disney properties. But again, it's a little bit of a wait and watch, but nothing explicitly, stated from Disney management about what they want to do with the linear piece of the business.
So ESPN is getting a fresh spin with an August 21 launch. It will be $30 a month for the new streaming app. What do you make of that price? Do you think people will pay up for it, or is that steep?
It's a high price point. There's no doubt about it. I think most people were kind of expecting somewhere in the $23 to $25 range. That said, we just ran a survey actually at Bloomberg Intelligence, and what we found is that there's actually a lot of interest in this product. So we think that the uptake will be fairly strong, and the uptake not so much as a standalone product, but when you bundle it with Disney Plus and Hulu. So they are running a pretty attractive promotion. So for the first year, you can get Disney Plus, Hulu, and ESPN. At a $30 price point, which seems like really good value. So I think we're going to see a lot of people come in initially through the bundles, at least.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media.
We move next to recent news from the beverage company Molson Coors.
This week, the company lowered its full-year guidance for the second quarter in a row. It cited continued pressure from a weak consumer, falling U.S. market share, and rising costs tied to aluminum tariffs.
For more, Lisa and I were joined by Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. We first asked Ken just how much aluminum tariffs have been impacting Molson Coors.
It's material. They describe it as an indirect cost, but it really spiked up there in the quarter, encroaching on their margin. I think, though, the bigger picture, though, here is the continued weak sales, the lackluster sales we're seeing in the U.S. beer market and alcoholic beverages in general. This is their peak summer selling season. This is when, these companies should be thriving, and it looks like the summer selling season in the U.S. for alcoholic beverages is going to be a dud. It's a cautious consumer. It's particular pressures on the Hispanic demographic. It was a lousy June in terms of the weather in key markets. And basically all the big brewers are setting up for a tough second half. They say, if these trends continue, expect continued sluggish performance in the second half as well.
So is this beer thing, is it kind of a global thing? I mean, I know you guys at Bloomberg Intelligence, you got the data that shows consumption of everything out there.
In the case of Molson Coors, Paul, yeah, they have a big operation in Europe, Eastern Europe, many parts of Western Europe, and that they had lower volumes as well. It was saved by higher prices to a degree, but again, the big picture is that consumers are just not going out to the bars as much. On-premise sales were particularly weak. That could be weather related.
I mean, that's just another example.
But also, I think it could be, the culmination of a lot of price increases over the last few years. Maybe we've hit a point where there's some sticker shock going on here.
And what about people drinking? You said not going to the bar, but what about just drinking less alcohol in general?
Well, that's a great point, Lisa. I think longer term, you have some secular headwinds as well. Things we've talked about in the past, the spread of legal cannabis, particularly here in the U.S. In the U.S., you also have these intoxicating hemp drinks, which are all the rage now in many markets. You have the GLP-1 users are cutting back. Gen Z doesn't seem to embrace alcohol as much as their parents did. All those things are weighing on it longer term, but that combined with some near-term pressures is really weighing on these companies.
This is a disappointing discussion here. I mean, I thought we were going to have fun here. I'll tell you, here's the problem with all this White Claw and Seabreeze and I don't know what, the iced tea and vodka. What's that all about? Is that a fad?
It seems to have some legs there. The pre-mixed cocktails. Well, let me put it this way. Some of the things that did well in the quarter are things like Busch Light Apple. Some flavor. Some of the hard teas are doing well. The premixes continue to do well. So I think what you could take away is maybe the consumer, while economizing, is also looking for flavor and different variety. And also the non-alcoholic and low alcoholic segment it continues to do well from a low base. So I think in the second half, I would expect a higher level of promotion and innovation along those themes: low alcohol, no alcohol, flavor, innovation. That's going to be really popular, I think, in the second half to spur volume.
Hey, before you go, Kenneth, can you break down some of those macro economic headwinds that the company's facing?
Sure. Well, the primary one is just, consumer confidence. Consumers just feel, they're reading the papers, all these, the tariff uncertainties and, the pressure on the Hispanics, in particular, what's going on there. Those are the big things, and I don't think it's anything major, but it's just enough on the margin that these are purchases that can be deferred, and consumers, by and large, are.
Our thanks to Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. Coming up, we'll look at earnings from one of the world's biggest producers of heavy machinery, Caterpillar.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
We move now to earnings from the software company Palantir Technologies.
This week, Palantir reported its biggest ever quarterly sales growth since the company went public. And Palantir cited astonishing impact of artificial intelligence technology on its business.
For more, Lisa and I were joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. We first asked Mandeep if Palantir should be considered a dominant software company of the future.
I mean, clearly there is a lot baked into the valuation, but I want to focus on, the net new ARR, which is a metric that software companies are measured on. And when you compare Palantir's commercial segment revenue, which everyone is excited about, sure, their total deal value that's remaining is around $2.8 billion. The new ARR increased by $500 million. Contrast that with a Microsoft or a Google Cloud. Microsoft added almost $9 billion in net new ARR this quarter. And they talked about, AI being used across 100 million Microsoft Copilot users, 20 million GitHub Copilot users. So from that perspective, Palantir's increase in remaining deal value of $500 million looks pretty small. I mean, Palantir's overall revenue run rate is $4 billion. Microsoft clearly is, a company that's almost 100 times or 80 times more bigger than Palantir. But it just goes to show that even on a net new ARR basis, Microsoft is adding more revenue per quarter than a Palantir is. And still people are very excited about Palantir's prospects. And to my mind, clearly, they have a product that is appealing to a certain section of enterprise users, but At this valuation, I mean, they can't sustain that for the next 30, 40 quarters, which is what they need to show to grow into the valuation. And I just don't see from a product perspective, they'll have the same kind of appeal as a Microsoft Copilot or a Google Cloud or, any of these large companies.
Dumb question of the day. How do you guys value this thing? I mean, I got it at like 200-300 times earnings, so that's not the way to go.
So we've seen that with, new IPOs. When they come to the market, they get a premium multiple. They get traded at, 30, 40 times sales. Snowflake, which is a competitor to Palantir, when it went public, it traded at 60, 70 times sales. Look at where the stock is now. It's flat since the IPO. Even though the company has grown top line at 30, 35% CAGR, the stock is flat. So that's what I mean by growing into the valuation, because there is so much embedded in that upfront multiple that even growing at 30% is not enough. Palantir really needs to grow at 50% to be able to show any sort of stock return from this point on.
Can it do that?
No, I mean, that's why I said I compare the product.
Yeah.
My initial comments were around comparing Palantir's product versus other large enterprise software makers. And even, you go down the list, Salesforce, ServiceNow, Adobe, like these are much bigger companies. And they have compounded at 20% CAGR over the years because they had a seat-based or a consumption-based model. We don't even know what kind of a business model Palantir has. Yes, it's winning government deals. Yes, it's winning some enterprise deals, but we don't know how they account for that revenue every quarter. Is it a seat-based model? Is it consumption-based? We don't have that kind of visibility to their business model.
I in a cocktail party, I can tell you the Google story. I can tell you the Microsoft story. I have no idea what the Palantir story is. Can you explain it to me like I'm a 5-year-old?
Yeah, so their software out of the box will help you make sense of your big data strategy. They really carved out a name for themselves when big data became the thing. When a company had a large amount of data, whether it's log data or some other type of reporting data, they would help you make sense of it because they have something proprietary that no one else has in terms of organizing that data and making it usable. So that's their value proposition. But with the AI wave and LLMs, they were able to integrate LLM calls within their offering to develop a customer service or a supply chain use case that you can apply AI on top of their ontology, which is their core product. And a lot of other companies are doing the same. To my mind, Microsoft is doing the same for their customers. They're trying to embed OpenAI with their core offerings, with their CRM system, and help them deploy a customer service use case. So the differentiation of Palantir versus Microsoft, to my mind, is not that big as the valuation reflects. And that's where I'm betting they're not going to grow 40, 50% for the next 12 to 20 quarters, which is what the valuation is implying.
Now, how would you compare what they do as far as a government contractor versus the commercial side? Like, which is doing better for them?
Yeah, so they have a much higher exposure to government side. I mean, government side is still more than 50% of their revenue. And all these large enterprise software companies, they have 10 to 15% government exposure. So Palantir's government exposure is way too large compared to other software makers. And on top of that, their international sales seem to be declining, at least, on the commercial side because of the polarizing views of the management. So if they were more balanced, probably they would win more international business. But right now, this is a US-centric story. And that's where I think it sort of puts a dent to the growth rate down the line once they run out of the deals that they currently have signed.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We look next at earnings from one of the world's biggest producers of heavy machinery, Caterpillar. This week, the company posted quarterly earnings that missed analyst expectations.
Caterpillar also said it now expects full-year adjusted operating profit to fall in the bottom of its annual target range, even with higher annual sales. And the company said it expects to face net incremental tariffs on $1.3 to $1.5 billion this year.
For more, Lisa and I were joined by Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. We first asked Chris to discuss his takeaways from Caterpillar's earnings.
The print was a little weak. It came in a little below expectations. the big takeaway here is that underlying demand is still pretty darn resilient. You had backlog up sequentially again this quarter, which set another record. You had improving order trends across all three of their main businesses. Dealer inventories still remain quite low, and the company actually raised their sales guidance for the year. So, that seems to suggest to us that underlying demand is still intact despite all these tariff headwinds.
And now, how do their results kind of match up to some of their peers? I believe there's Terex, Lindsay, who already opened their books. How does Caterpillar match up?
Yeah, I'd characterize the overall earnings season for U.S. machinery is kind of mixed. If you think about really construction peers, which is kind of more Caterpillar's sweet spot, that's a market that's kind of bouncing along the bottom here. We do have infrastructure projects and these large mega projects which are helping to offset some of the weakness that you're seeing on the private non-residential side, things that are more interest rate sensitive. But you're starting to see some positive indicators that would lead us to believe that you're going to start to see a cyclical recovery emerge in 2026. There's a number of leading indicators out there that would support that, and I think really Caterpillar's results here, with orders being up in the construction business, with the backlog being up, really kind of reinforce that view.
Where does Caterpillar make their big trucks and stuff like that?
Everywhere, right? They're a global company. They've got a large footprint that spans every continent and most countries. But if you think about it, at the end of the day, it's North America, right? It's more than half of their revenues. Europe is, call it 20%-ish. Asia Pacific a little bit below that, and then Latin America is kind of closer to 10%. They are a net exporter out of the U.S., but as we saw, tariffs probably going to be a little bit more of a headwind than they had initially anticipated. They're looking for somewhere between a $1.3 to $1.5 billion hit for this year.
So, Chris, you kind of touched upon this. Sales slipped in construction, resource industries, but energy and transportation unit, that had some higher sales. What is that driving force behind the growth in engines and transportation?
So this continues to be one of really the big highlights for Caterpillar, despite some of the cyclical softness that they're seeing, is the energy and transportation business, particularly in power generation. So think, data centers are becoming an increasingly larger part of the portfolio. Power gen continues to drive outsized growth within the energy and transportation business. There's, a multi-year backlog there, so we have, really tremendous visibility. And what Caterpillar is doing now is really expanding capacity to help meet this growing demand for data centers and power generation. So there's a long secular tailwind at play here, and really we think we have pretty good visibility here over the back half of the decade.
Is Caterpillar and companies like Caterpillar, are they benefiting, or do you expect them to benefit from maybe onshoring even more manufacturing in this country, if to the extent that President Trump, wants to do that, and he's been talking about that a lot? Is that something where Cat will see it?
Yeah, I mean, I would say we haven't really heard of, I would say concrete or tangible evidence of that happening yet, and it's really difficult to, get a lens on that on a quarter to quarter. I think, if we look back maybe over a 5-year window, maybe we'll have a better picture of that. But yet, no doubt, Caterpillar is a big beneficiary of any kind of construction activity here domestically. And then not only on top of, not only just moving the dirt and building the facilities, they're also, like I mentioned, have a bigger piece of the data center and power generation needs within our country as well. So it's really kind of twofold, not only with the moving the dirt and the facilities, but also longer term, we think the secular tailwinds around power generation are pretty favorable.
Hey, Chris, before you go, we have about a minute or so left. People usually say this is like the bellwether for a look at the economy. Is this company going to continue to be that spot and to hold that title?
I don't see anything changing in the near term here. They are the largest global manufacturer of heavy machinery. They have the scale, the dealer network, and really there's not too many competitors that are that close to them. So they are the leading indicator for the heavy machinery markets and construction activity, and I don't foresee that changing anytime soon.
Our thanks to Christopher Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. Coming up, we'll look at why the EV giant Tesla approved a $30 billion stock award for its CEO, Elon Musk.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence. We move now to second quarter earnings from the fast food giant McDonald's.
This week, McDonald's reported their global sales at restaurants open at least 13 months rose 3.8% last quarter.
This suggests that pop culture-focused collaborations and budget meals are helping to offset diners' economic anxiety.
For more, guest host Isabel Lee and I were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst. We first asked Mike if returning to sales growth feels like a win for McDonald's.
It's definitely a win for, overall industry same-store sales because it's such a monster. It also could be bad news for some of their competitors with 14,000 stores in the United States. Listen, man, they know how to run good restaurants, right? Right now in the U.S., they're starting to lap some easier comparisons, and that's showing up in that's helping their results. They're also doing a good job with, the menu, right? They're bringing back snack wraps. They're bringing back the McCrispy strip. They just debuted a daily double. They've been pressing on value all year. That was a big thing since the first quarter. And so, McDonald's has the scale that they can, offer products a little bit cheaper than their peers and the franchisees can still make a little bit of money off of it, right? So, they seem to really be hitting their stride, and they're lapping easy comps in the second half of the year. So, we're looking at a pretty good second half for McDonald's.
And international markets led the company's growth. What regions of the world did they really push aggressively towards?
Yeah, they mentioned some really good strength in Germany. They talked about some improvement in some markets that had been struggling, like France and Australia. And so, what they're doing overseas is similar to the U.S. playbook, right? But they're probably ahead of the game, ahead of the U.S. in terms of providing everyday value. Their value messaging has been on point, and it's really helped them grow internationally. And that's why we've seen international grow faster than U.S. for the last year or so. They also cited the fact that there's less competition overseas. So they're really, a pricing leader overseas. They can, same type of thing in the U.S. where they can offer price points that competitors just can't match. And then they're also improving the operations, improving the quality of the product, which has been an ongoing theme here. They're improving the quality of the beef, better burgers, the way they cook the burgers. They're debuting the Big Arch, which is a bigger sized burger in their lineup. They're also expanding chicken overseas. So this company's humming along right now.
What does a company say? Like when I think about McDonald's, I think a lot of folks probably feel like the low income consumers, probably it's bread and butter there. And maybe that consumers are more at risk in this economic environment. What's the company saying about low income patrons?
Yeah, you know what I like about this call, Paul, is that, they're talking about what they can control. They cited the fact that low income consumer traffic is down double digits, right? Versus a small gain for middle-income consumers and steady, consistent gains with high-income consumers. So they are seeing, weakness with low-income consumers like everyone else. That's why they push so hard on value. That's why they have these, $5 meals and buy one, get one for $1, and why they put marketing dollars behind that. That's part of the beauty of the snack wraps. They're coming back at a $2.99 price point. We think that's going to bring some low-income consumers back into the fold, right? So they understand that people are very price sensitive right now, and they're addressing it with the price points, but they're also trying to give people better quality and better service at the same time.
They also plan to taste new beverages. This includes cold coffees and crafted sodas at more than 500 U.S. locations. How much of a pull are beverages when it comes to McDonald's offerings, or is food really still king?
food is still king, but listen, beverages are hot. Beverages are hot everywhere, right? Dirty
high
sodas, energy, and very high margin, right? And so we think this is a very good opportunity for McDonald's. I think this is kind of a problem for Sonic, which has long done a really good job with their drink offering. But yeah, we think this is something that can help drive sales at McDonald's. Taco Bell, this is something Taco Bell's expanding as well. But we think this is going to be more of a 2026 story for McDonald's.
For McDonald's, Mike, what percentage of the revenue comes from owned and operated stores versus franchise stores?
Oh, they're 98% franchise. So they're heavily franchised, and it's a beautiful model, man. There's not a lot of operating leverage in the model. They generate a ton of cash that they return to shareholders. It really is a beautiful thing.
So what's the royalty rate on? Does a franchisee pay McDonald's based upon revenue, based upon net income, based upon how many Big Macs they sell? How's that work?
Yeah. McDonald's is a little bit unique. They have a 5-ish% royalty rate, plus they own a lot of the real estate. So a lot of franchisees in the United States are paying a rent, which is typically, 10-ish% of sales, we'll say. And then they'll pay another 3.5% to 4% into the ad fund.
I didn't know that until I saw the movie. Yeah. And then that famous scene.
Yeah.
You're not in the hamburger business, you're in the real estate business. And that was such a great scene. I learned a lot there. All right, I can't let you go without Cracker Barrel. I need my daily update. Country Boy Breakfast. How's that company doing?
Listen, we're big fans of new CEO Julie Masino. That stock's been a bit of a roller coaster. Not a surprise since it's a small cap. It rose more than 100% off its April lows. Now it's in the midst of a pretty aggressive downturn. But we like it. We like Julie's plans to improve the operations, to spend more and be more efficient with their marketing spend. We think this is a chain that hadn't been taken care of. It hadn't been run really well for the last decade. And so we see a lot of low-hanging fruit for the current management team to turn things around and really drive strong same-store sales through year-end 2025 and well into 2026.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst. We move next to news at the EV giant Tesla.
This week, we heard that Tesla approved an interim stock award worth about $30 billion for Chief Executive Officer Elon Musk to keep his attention on the automaker.
The award includes 96 million shares of the automaker that will vest if Musk continues to serve in the top post for another 2 years.
For more, guest host Norma Linda and I were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. First, ask Steve what he makes of this stock award.
I think it's very positive news for Tesla because they are going through a pivot right now. Not only an automaker, but they're very focused on AI. But if you look at Elon Musk, Tesla is not his only business, right? He's got xAI, his AI company, which owns the former Twitter, and he also has SpaceX, Neuralink. I think they're all related in some ways to AI. And I think, without Elon Musk and Tesla, I think, there's going to be a lot of risk to that vision for Tesla without him there.
Steve, you mentioned that there are a lot of different things that are vying for Musk's attention. Of course, we do know that he was really politically involved, and then we thought kind of pulled back, and then he mentioned his intention for creating the America Party. So clearly he still remains in these conversations here. But what are investors looking for right now from him? And does it seem as though his attention is devoted as much as it should be to Tesla?
Yeah, I think fortunately for now, his attention is very much devoted to Tesla. And he said that at the second quarter earnings call. I think, his presence is important because, right now, the company's going through a changeover in terms of the direction, the strategy, right? Cars has been very important. It continues to be important to drive that AI theme. But without Musk there, I think the company will have to, won't able to find the next person really to drive the company to the next step in expanding robotaxi, expanding their Optimus robot offering in the future.
Do we care about how many cars they make and whether they make any money in the old car business, Steve?
We do. And a lot of people think that it's a full pivot towards AI, But I think making cars and developing that AI software goes hand in hand. It's almost like Apple and its ecosystem. I mean, there are opportunities for Tesla to actually license the FSD, the full self-driving software out. But I think in the meantime, it's not something he's looking to do. I think he wants to build out robotaxi internally and actually drive revenue and profits. He does see huge profits from the robotaxi and from the FSD software. If you look at other software companies, margins are high double digits on the software for any software. But then, with his FSD software, the car is an integrated component to it. It's very important that he continues to make cars not only for cash, but for really marketing that software that he has.
Steve, a lot pressuring Tesla over the last few months. I mean, we're looking at a stock. It's the worst performing stock within all the Mag 7 stocks that there are right now. Explain to me right now what the latest overhangs are right now for the company.
Well, I think one big overhang that's been removed is his pay package. There is a lot of fear in terms of him potentially being kicked out of Tesla. But I think the biggest overhang right now, or where the investors are more focused on, is the expansion of robotaxi. Right? He launched it back in June in Austin. He's launching it in the San Francisco Bay Area, and he's also thinking about launching it in Nevada. And from the looks of it, it's going quite well. I mean, there are some hiccups here and there with this complex engineering system that he's putting in place for cars. It's normal. It's normal. So, but safety is still his priority, and he's going at it at a measured pace. But it seems like he's expanding it relatively fast. The area of coverage is much bigger than it initially was back in Austin back in June, and we're seeing something similar in San Francisco. So investors are really focused on when robotaxi will start contributing to the bottom line, and we think that probably more likely in 2027.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.